Welcome to Pagoda Podcast, where we explore ideas, strategies, and insights to help businesses grow and scale.
And today we are doing a deep dive into a topic that, let's be honest, most business owners would rather avoid.
Taxes.
Exactly. But we're going to flip the script. We've gone through a lot of material, including some really sharp strategies from firms like Black Pagoda, and we're focusing on small businesses.
Specifically those in Arizona and Texas, or maybe even operating across both.
Right. The whole mission here is to shift your perspective. We want to show you that tax planning isn't just a compliance task you do once a year.
It's a business strategy, a real lever for growth.
It's absolutely central to your growth strategy. If you're not thinking about it year-round, you're leaving stability, confidence, and frankly, a lot of profit on the table.
Okay, let's unpack this then. Why is that traditional, once-a-year scramble so risky for a company that's trying to grow?
Well, it's human nature, right, to put off the hard stuff. But for a business, that delay has very real, very tangible consequences. When you're purely reactive, waiting until, say, February or March to even look at the last year, you give up three critical advantages.
Okay, so lay those three out for us. What are the big losses?
First, and this is the one that hurts the most, you lose control over your cash flow.
Completely.
I mean, you operate for a full 12 months, totally blind to what your final liability will be. Then this huge unplanned payment comes due.
And it can just cripple you, right, when you're trying to plan the new year.
It ruins January for so many business owners. The second loss is missing out on deductions, real legitimate deductions.
Because you can't remember what you spent in April.
Exactly. You can't prove it. The documentation for, say, mileage or a specific tech purchase, it needs to be tracked in real time. Trying to piece that together a year later, You're just not going to maximize it.
So it's not that it wasn't deductible, it's that you can't properly document it.
No, precisely. And the third loss is the most strategic. You end up making huge business decisions, like hiring someone or buying a big piece of equipment without understanding the tax impact.
Okay, that's a big one.
It is. You might invest a ton in automation in Q3, only to realize you didn't structure it in a way to get the maximum immediate tax benefit. That's why year-round planning gives you clarity. It gives you confidence.
And that confidence becomes even more critical when you're navigating the very different tax worlds of, say, Arizona and Texas.
Oh, absolutely. The rules change the second you cross that state line, sometimes even if it's just a remote employee or a few online sales.
Yeah, the common myth I always hear is that Texas is simple. No state income tax, so it's a tax haven.
That is a very dangerous oversimplification. It's just not true for businesses.
So what's the reality?
The reality is that Texas just shifts the complexity. Instead of a personal income tax, businesses have to deal with the Texas franchise tax.
Okay, break that down for someone who isn't a CPA. What is that?
So instead of taxing your profit, the franchise tax is generally levied on a business's margin. It's a really complex calculation, and it ensures Texas businesses are contributing, just not through a traditional income model.
So the complexity is still there, it's just different.
Exactly. And on top of that, you have really complex sales tax rules and, this is critical, multi-state nexus issues. If you're a business in Phoenix and you start making significant sales into Dallas,
You've just created a whole new set of problems.
you've created nexus, and now you have to file and pay that Texas franchise tax. It's a headache if you're not prepared.
Now, what about Arizona? How does that compare?
Arizona is more straightforward in a way. It does have a state income tax, but, and this is key, Arizona offers a lot of very specific deductions and credits.
Aimed at certain industries.
Yeah, things like R&D, specific investments. If you know how to use them, they can be incredibly favorable. But if you're reactive, you just pay the standard rate and you miss all those benefits.
So if you're a growing business in both states, that early structured planning is absolutely non-negotiable.
It's a compliance nightmare waiting to happen otherwise. The moment you expand, your compliance burden can double if you don't have the systems in place from day one.
Okay, let's talk about something that seems really basic but gets overlooked all the time. The business structure itself, your entity type.
It is so foundational, and yet so many owners just set it and forget it. Sticking with an outdated structure is one of the biggest hidden costs of growth I see.
So whether you're an LLC, an S-Corp, that choice has a direct impact.
A massive impact on your tax burden and, maybe more importantly, how the income actually flows to you as the owner.
I can just picture it. A service firm in San Antonio or maybe an e-commerce brand in Tucson. They start out as a simple little LLC.
Right.
Now they're making $400,000 in profit but they're still filing under that same simple structure.
And they are paying way too much in tax. Way too much. As a simple LLC, all of that profit is subject to income tax and self-employment tax.
That's the double hit.
It's a massive double hit. Social Security, Medicare, the works.
So what's the move? What's the strategic fix there?
For many, it's restructuring to an S corporation. Assuming you qualify, it lets you split your income into a reasonable salary and then distributions.
And the distributions don't get hit with that self-employment tax.
Correct. That change alone can save a high-earning business owner tens of thousands of dollars every single year.
But I imagine changing your entity type feels like a huge, messy process. Is it always worth it?
That's a fair question. Look, if you're just starting out, maybe not. But once your profit starts hitting a certain level, maybe, say, north of $100,000, the tax savings almost always crush the legal fees.
And there's a long-term benefit too, right?
A huge one. A business with an optimized tax structure is just so much more attractive for a future sale. The finances are clean, the inefficiencies are gone. It adds real value.
Okay, so your structure has to evolve as your revenue does. Let's get tactical now. Deductions. What are the big areas where business owners just leave money on the table?
The root cause is always the same. No real-time visibility. It's not that they don't know things are deductible, it's that the records just aren't there when it's time to file.
If you didn't track it in June, you can't find it in January.
You got it. So, beyond the obvious stuff, we see underutilization in a few key areas. Technology and equipment investments, for sure.
Yeah.
The home office deduction, if you actually qualify for it. Vehicle and travel expenses are always a mess. And retirement contributions. So many owners underutilize things like SEP IRAs or solo 401ks.
You mentioned an interesting example about depreciation. How can that actually improve your cash flow right now?
Right, this is where it gets really powerful. Let's take that Austin-based professional services firm. Let's say it's a growing marketing agency.
Right.
They decide to spend $50,000 on new computers and some automation software in December. Now, standard depreciation would spread that deduction out over like 5 or 7 years.
You only get a little bit of a tax break this year.
A tiny piece. But with proactive planning, they can use Section 179 or bonus depreciation rules. That lets them deduct the entire $50,000 this year.
Wow.
So if that firm's in, say, a 30% tax bracket, that one move just saved them $15,000 in cash. Cold, hard cash that they don't have to send to the government.
That is a massive immediate difference. That makes the investment in automation pay for itself so much faster.
That is the whole point. Good data allows you to make smart investments that directly lower your tax bill. You turn a liability into a growth tool.
Okay, building on that idea of timing, let's talk about timing, income, and expenses. How powerful is just legally shifting things around the calendar?
It's like being the quarterback of your cash flow. For most small businesses, the game is to legally accelerate your expenses.
Pay for things early.
Right, and defer your income into the next tax period. So think about prepaying for your software subscription for next year in December instead of January.
You pull that deduction into this year?
You pull it into the current tax year, lowering your bill right now. On the flip side, if you have a big client payment coming in late December, maybe you hold off on sending that invoice until the first week of January.
Pushing the taxable income into the next year.
Exactly. This is why businesses in dynamic markets like Phoenix or Houston have to stop thinking annually. They need to be doing quarterly planning.
To avoid those year-end surprises.
It eliminates them. You review your numbers every 3 months, you apply these timing strategies, and you maintain complete control over your capital. You're always ahead of the curve.
This all sounds like it requires a lot more than a shoebox full of receipts. This is where automation has to play a role.
Automation is the absolute backbone of modern tax strategy. Manual bookkeeping is a relic. It's slow, it's full of errors, and it gives you zero real-time visibility.
So an automated system just gives you cleaner, faster data.
And more trustworthy data. It lets the humans, the business owner, and their CPA focus on strategy instead of data entry. This is what you see with firms like Pagoda, combining AI-driven insights with that critical human expertise.
The tech handles the grunt work, and the people handle the thinking.
That's the model. It empowers faster, much smarter decisions.
So let's make that final connection. We started by saying tax planning is a growth strategy. How does all this actually help me scale my business?
It helps you scale by removing uncertainty. It's that simple. It supports better, more confident decisions about hiring, about expansion, about any major capital investment. You stop guessing what the true cost of your next move is.
Can you give me a real-world example of that?
Sure, think about a retail business in Dallas that wants to open a second store.
Okay.
Before they sign that lease, they have to understand the tax impact. The new sales tax nexus, the depreciation on the build-out, the change to their franchise tax. If they plan it right, the expansion works. If they don't, they could get hit with an unexpected tax bill that kills the new store's profitability in year one.
And for a service business.
An Arizona-based service firm can strategically align their compensation. They can plan bonuses and retirement contributions to be as tax efficient as possible. That helps them attract and keep the best people while optimizing the owner's own tax situations.
So what this all really means is you get to scale with confidence. You know the financial foundation is solid.
Yes. When tax planning is woven into your growth planning, you remove the hidden costs. It turns scaling from a gamble into a managed strategic process.
We've mentioned the approach from firms like Black Pagoda a few times. Can you sum up how they help businesses get this kind of clarity?
Yeah, their whole mission is about turning these complex business challenges into clear, actionable growth stories. They use technology like AI, but they combine it with deep human expertise in finance and in, deal execution. They help businesses grow and scale and even sell. They have trusted brokerage services, especially in Arizona.
It all comes back to clarity and confidence.
That's the goal, empowering owners to act decisively because they have the right information.
That foresight seems truly invaluable.
It really is. And, that brings us to the final thought for you, the listener. Tax planning is not about doing more work.
It's about doing smarter work.
That's it. It's about doing smarter work. Proactive planning, using automation to get real-time data and getting expert guidance, those are the foundations for stability, for growth, and for maximizing the value of what you're building. That foresight is what separates the market leaders from everyone else.
Well said. For those listening who want to explore this integrated approach further, you can learn more about Black Pagoda strategies at http://www.blackpagoda.com. Thanks for joining us for this deep dive.